It's causing a significant change in trade that is shaking North America. While the United States fights trade disputes and tariff warfare, Canada is establishing itself as the next leading supplier to the EU and NATO by making audacious economic decisions. With international trade on the line, may this force American companies to scramble for leverage? The stakes are really high. Let's examine 7 major ways that Canada's approach can challenge American hegemony. Canada's strategic power play in the NATO pitch. Canada's most recent trade initiative went beyond just diplomatic chit-chat. It was a well-thought-out commercial decision made during crucial discussions with EU leaders and NATO. In addition to talking about military ties, Prime Minister Justin Trudeau positioned Canada as the ideal substitute for American suppliers. It was an obvious message. Compared to its southern neighbor, Canada offers secure trade relations, competitive pricing, and less geopolitical issues. When it comes to servicing European markets, Canada has a logistical and legal edge over U.S. companies thanks to the comprehensive economic and trade agreement. Washington's negotiating power in trade talks may suffer significantly if NATO members begin moving their supply lines north. The question is whether the United States anticipated this action or if it was taken by surprise. American economic power is reduced. For many years, the United States has dominated the economies of NATO members, particularly in sectors like energy and aerospace technology. However, Canada is now providing European businesses with a simple means of diversifying their imports and lessening their dependency on American vendors. In what way? Direct supplier agreements and lower trade restrictions are making it more desirable for European companies to forge alliances with Canadian companies rather than with American ones. In addition to potentially undermining American influence over NATO economies and upending trade policies that have historically benefited American companies, this change could result in billions of dollars in lost revenue for American firms. It's not only about making sales. Power is at issue. Canada is currently attempting to shift the balance. The energy power move by Canada, a danger to American exports. Canada is taking decisive action to challenge American energy hegemony by establishing itself as a major supplier to Europe. By 2024, Europe's transition to nuclear power was aided by 75% of Canada's uranium exports, highlighting its expanding significance in global energy security. Nevertheless, obstacles stand in the way of Canada's aspirations for LNG. Large reserves, nevertheless. Development has been hindered by exorbitant expenses and inadequate infrastructure. In order to establish LNG terminals, Prime Minister Justin Trudeau acknowledged that large, sustained investments are required. But Canadian energy companies are still landing big international contracts. Vista Energy, a new company in Canada, and Trafigura recently inked a long-term natural gas deal that will have an effect on global markets by 2027. Canada has the potential to become a powerful force in the energy industry, change the way energy moves across the world, and lessen Europe's reliance on American exports if it can overcome its obstacles. Prior to going farther, would you kindly hit the like and subscribe buttons? This makes it easier for us to connect with additional car enthusiasts. Let's change course and go on to our next objective. In both trade and tariff disputes, Canada prevails, growing Canada and the United States. Due to trade concerns, Canada has been forced to diversify its alliances and lessen its dependency on U.S. exports. In retaliation for Washington's 25% tax on Canadian steel and aluminum, Canada imposed duties on $155 billion worth of American exports while fortifying its connections with Asia, Europe, and Latin America. Canada has increased its market reach in the Asia-Pacific region by joining the CPTPP. These accords have strengthened Canada's position as a trustworthy alternative supplier, even if CETA has led to a 57% rise in Canada-EU trade since 2017. With more investments in local manufacturing and energy exports, Canada can shift its focus to alternative markets if the United States continues to impose trade restrictions. Canada is defending itself against economic pressure from the U.S. and establishing itself as a growing trading power in the world. Is the United States able to continue displacing Canada? The change in Europe. Canada gains support. As tensions between the U.S. and the EU increase, Canada is taking advantage of the opportunity to deepen its trading relations with Europe after the introduction of CETA in 2017. Canada. EU commerce has increased by 57%, indicating an increasing trend away from reliance on the U.S. Key economic superpowers. France and Germany are keen to diversify their supply chains, especially in vital energy and mineral sectors. Trade Minister Mary Ng's visit to Brussels highlighted Canada's long-term significance, while recent high-level discussions with Prime Minister Justin Trudeau and EU officials have reaffirmed Canada's position as a dependable trading partner amid mounting uncertainty. With the U.S., Europe is looking north more and more as its leaders attempt to challenge U.S. trade restrictions and tariffs, with Canada providing stability and less political barriers. This might irreversibly alter transatlantic commercial relations. The data, changing economic tides, don't lie. What political scheming has already indicated is supported by trade statistics. The trade power balance in North America is shifting. EU-US commerce totaled €851 billion in 2023, leaving the EU with a €157 billion surplus. Nonetheless, EU trade increased by 65% under Canada between 2016 and 2022. Canada's exports to the EU fell 15.7% in late 2020, causing its trade deficit to marginally increase despite this rise. But this drop might only last a short while. In order to solidify Canada's position as a vital supplier, active discussions are underway in the vital energy and minerals industries. Just a 5% to 10% increase in transatlantic imports from the United States to Canada might generate billions of dollars for Canadian companies because of trade restrictions and tariffs imposed by the U.S. Businesses in Europe are already looking for new suppliers, and Canada is putting itself forward as the solution. Retaliation or adaptation at the U.S. crossroads. With Canada gaining a larger share of the world economy, Washington must decide whether to use strong trade incentives to retain European allies or to exert economic pressure to stop Canada from establishing its newfound supremacy. Every route has dangers. It might lose its own economic advantages if the United States offers better terms, but it might drive European companies even more to Canada if it responds with more stringent trade restrictions. The U.S. is now observing. However, Washington is likely to react if Canada continues to make progress. Whether it is through trade disputes, policy changes, or new tariffs, the struggle for supremacy and transatlantic trade is far from over. Is Canada on the verge of winning? An economic showdown with significant stakes has swiftly developed from what began as a strategic trade adjustment. Canada had no intention of starting a trade war, but it is evident that the trade order in North America is changing as a result of its expanding influence and growing alliances. Thus, it is still unclear if the United States will resist, or is Canada headed toward achieving full independence as a trading power? We would like your opinion. Is Canada negotiating with the United States, or is it making a daring power move? Tell us what you think in the comments section below. Remember to subscribe to my channel for additional in-depth analyses of the major power struggles in the automotive industry and international trade. Press that alert button so you don't miss any more updates. I appreciate you listening. In the next one, see you. The world of international trade and geopolitics is about to be shaken in a way we haven't seen in years. Canada and NATO have just made a bold move that could change the balance of trade between North America and the U.S. forever. Today, we're diving deep into the emerging trade crisis, how electric vehicles, oil, and tariff wars could reshape the future of global commerce, and what this means for you. Welcome back, everyone. If you're new here, make sure to hit that subscribe button and ring the bell to stay updated on the latest global developments. Today, we're talking about a potentially huge turning point in global trade, and it's coming straight out of Canada. But it doesn't end there. NATO countries are also making waves that are sure to leave the U.S. stunned. For decades, the U.S. and Canada have had a relatively smooth trade relationship, especially after NAFTA was replaced by the USMCA. But now, things are starting to get rocky. The relationship is about to be tested by new global challenges that are causing deep rifts in international commerce. Canada has always been one of the U.S.'s most important trading partners, especially when it comes to energy, natural resources, and technology. But in recent years, several factors have thrown a wrench into the gears of this partnership, from the U.S. as tariffs on Canadian steel and aluminum to new shifts in global energy markets. And it's not just Canada. NATO allies are also playing an increasingly important role in shaping global trade. With growing tensions between the U.S. and its allies, it's no surprise that the dynamics between these countries are changing. One of the most surprising moves Canada and NATO have made is in the electric vehicle sector. With the Biden administration pushing for a massive shift to electric vehicles, Canada has decided to jump on board with its own ambitious plans. But this isn't just about climate change. It's a strategic move that could lead to a trade war with the U.S. Canada has just announced a new set of policies aimed at becoming a global leader in electric vehicle production, from battery manufacturing to EV supply chains. In fact, Canada has the potential to produce the materials needed for EV batteries, such as lithium, cobalt, and nickel, which are critical for the next-generation vehicles. Canada is in an excellent position to leverage its natural resources, not only to supply the U.S., but to create an entirely independent market for electric vehicle infrastructure that can rival the U.S. and China. It's a bold move that could force the U.S. to reconsider its dependency on foreign imports and rethink its own EV policies. But here's the kicker. As Canada accelerates its push for EV dominance, it could put pressure on the U.S.'s own automotive industry, especially with potential tariffs, trade restrictions, or competition in the global market. And this is where the tension starts to rise. Now let's talk about one of the most vital resources in global trade: oil. For years, Canada has been a major energy exporter to the U.S., but that's changing. As the world shifts towards renewable energy and electric vehicles, Canada is starting to turn its focus inward and even outward to diversify its energy trade. Canada is looking to break free from U.S. dependency by selling more oil to Europe and other NATO countries, cutting down its reliance on the American market. Meanwhile, the U.S. is exploring alternative sources of oil, but it's also dealing with internal issues like regulatory challenges, environmental concerns, and the politics of fossil fuels. Canada's oil market is massive, and it's not just about sending crude to the U.S. anymore. There's a real shift towards Europe and Asia, and with Canada's vast renewable energy projects, it's positioning itself as a leader in both the oil and green energy sectors. The question now is, what will this do to U.S. energy markets? Could Canada's energy exports to Europe and other NATO allies cause a dip in the U.S. oil market? Could it lead to a trade standoff over energy resources? If this wasn't enough, let's throw tariffs into the mix. As the U.S. and Canada are getting more competitive on the global stage, we're seeing the first signs of a potential trade war. With the Biden administration already imposing tariffs on Canadian products like steel and aluminum, Canada has now threatened to retaliate in a big way. Canada's government has said that if the U.S. continues to impose tariffs on critical industries, it will have no choice but to respond in kind. But this is where it gets interesting. NATO countries, particularly in Europe, are starting to get involved in these trade issues too. Could we see a NATO-wide shift in trade policy that forces the U.S. to rethink its tariff strategy? These tariff wars could lead to massive shifts in global trade. What happens if Canada and NATO countries impose tariffs on U.S. goods? Could the U.S. be forced to renegotiate major trade deals, or worse, suffer a trade crisis? Oh, what does this all mean for the future of U.S.-Canada relations, for the American consumer, and for global trade in general? The reality is that these tensions are just the tip of the iceberg. A trade crisis is brewing, and we could be on the cusp of seeing a whole new world order in international commerce. For the average consumer, this could mean higher prices on goods, especially when it comes to energy and vehicles. For businesses, it could mean navigating new tariffs and regulations that disrupt established supply chains. And for nations, it could spark a realignment of global trade alliances. The next few months and years could reshape the global economy in ways we can't yet fully predict. Will Canada and NATO successfully stand up to the U.S.? Or will the U.S. impose its will through economic pressure? Recent developments in international trade policies have led to significant tensions between the United States, its allies, and other global economies, particularly concerning tariffs on electric vehicles, EVs, oil, and other goods. In August 2024, Canada announced a 100% tariff on Chinese-made electric vehicles, aligning with the United States' earlier decision to impose similar tariffs. This move aimed to counteract China's state-directed policy of overcapacity, which was perceived to undermine domestic industries in North America. Additionally, Canada imposed a 25% tariff on imported steel and aluminum from China. Prime Minister Justin Trudeau stated that these measures were necessary to protect Canadian industries from unfair competition. In February 2025, U.S. President Donald Trump threatened to impose a 25% tariff on imports from the European Union, criticizing the bloc for policies he claimed were detrimental to the U.S. economy. This announcement raised concerns about a potential transatlantic trade war, with the European Commission indicating it would respond firmly to any unjust trade barriers. The proposed tariffs have significant implications for the automotive industry. John Elkann, chairman of automaker Stellantis, urged President Trump to maintain tariff-free imports from Mexico and Canada, emphasizing that a 25% tariff on vehicles from these countries could severely impact the company's profits and the broader North American automotive sector. Stellantis, along with other manufacturers like General Motors and Ford, relies heavily on production facilities in Mexico and Canada. Elkann argued that such tariffs would disproportionately benefit Asian and European competitors. The Trump administration also revoked a license granted during the Biden era that allowed Venezuela to produce oil, citing non-compliance with deportation agreements. This action could have ramifications for global oil markets, potentially leading to increased volatility and affecting energy prices worldwide. The escalation of tariff measures and trade threats has led to fluctuations in global financial markets. Following President Trump's announcement of impending tariffs on Mexico, Canada, and China, the U.S. dollar experienced a rally, while the pound and the euro declined against it. The European Central Bank expressed concerns over the potential impact of these tariffs on the Eurozone economy, warning of possible economic contraction in both the EU and the U.S. if a trade war ensues. Diplomatically, these trade tensions have strained relationships between the U.S. and its traditional allies. The imposition of tariffs and the threat of further trade barriers have led to criticisms from European leaders and warnings about the potential for serious trade conflicts. These developments underscore the complex interplay between trade policies, economic interests, and international alliances in the current global landscape. The recent trade tensions between the US, Canada, NATO allies, and China are significantly affecting the car trade, particularly regarding tariffs on electric vehicles, EVs, automotive parts, and international supply chains. Tariff threats. Former U.S. President Donald Trump has suggested imposing a 25% tariff on vehicles imported from Canada and Mexico if he returns to office. Industry concerns. Automakers like Stellantis, Ford, and General Motors are warning that such tariffs would increase car prices and disrupt North American manufacturing, as many vehicles are produced in Mexico and Canada before being sold in the U.S. Potential impact. The tariffs could lead to job losses in assembly plants, higher consumer prices, and reduced competitiveness against European and Asian automakers. Trump's 25% tariff threat. The U.S. has also threatened a 25% tariff on European cars as part of a broader trade dispute, particularly targeting Germany's Volkswagen, BMW, and Mercedes-Benz. EU's response. The European Commission has vowed to retaliate with its own trade measures, which could escalate into a trade war affecting automakers on both sides.